The price that oil, natural gas, and petroleum products sell for is not simply a function of the cost of producing these fuels. It is also a function of the demand for the fuels. The factors that influence supply and demand are so complex that it has proven nigh impossible to decipher why fuel prices are what they are or predict what they will be with any consistent accuracy. Consequently, I'll discuss supply and demand in mostly conceptual terms, and I'll do so for oil, for it is a globally traded commodity whose price is principally set by worldwide supply and demand. I'll start with the supply curve for oil. The supply curve can be constructed by taking the major oil-producing regions in the world and plotting the cumulative quantity of their reserves as a function of each region's average cost to produce these reserves. So, for example, average production costs in the Middle East are about $27 per barrel, which is the lowest in the world. Total liquid production from the Middle East, including condensate as well as oil, is about 22 million barrels per day. The horizontal line running from 0 to 22 million barrels per day at $27 per barrel then reflects the average cost and amount of the world's cheapest accessible oil. Next comes offshore shelf or shallow water production around the world, which averages $41 per barrel to produce and represents another 18 million barrels per day of global production. This brings the total amount of accessible oil in the world that could be produced for roughly $41 per barrel or less to about 40 million barrels per day. Reserves and production costs from other regions of the world are added to the graph accordingly. The boxes surrounding each region's average price reflect the variation in production costs for that region. So, for example, the variation in production costs in the Middle East range between $10 a barrel to $35 a barrel, which is a smaller spread than the production costs in the offshore shelf regions, which can be as low as $10 a barrel to as high as $70 a barrel. With the world supply curve for oil established, the next step is to get some sense of the world demand curve for oil. A quick and dirty way of doing this is to plot for the same time period the annual world consumption of oil and the average annual price of a global oil benchmark such as Brent crude. In this particular plot, the annual oil prices have been adjusted for inflation and so are real prices in 2015 dollars. Note that while these prices have fluctuated over the years from below $20 a barrel to in excess of $100 a barrel, global demand for oil has, to first order, continued to rise. This implies that global demand is relatively insensitive to the price of oil and that the demand curve is very inelastic, meaning that in any given year, demand is constant over a range of prices and so plots as an almost vertical line. Furthermore, as global demand has grown over the years, the near vertical demand curve has tended to shift to the right. And in doing so, more and more expensive crude oils have had to be tapped in order to meet the rising demand. The motivator to tap these more expensive crudes has been the rising market clearing price for oil. Note then that the price of oil is set by the highest cost crude that, along with all the lesser cost crudes, provides a cumulative level of global supply that meets the global demand for oil. Also note that the lower the cost of a producer's crude, the greater the profit they receive for their oil at that price. So, in general, oil prices have risen over the past several decades because we have had to tap more and more expensive to produce oil to meet rising demand. And as it looks like demand will continue to increase into the future, it is reasonable to expect that oil prices will also continue to rise. However, looking at past oil prices, it's clear that the price can also undergo significant falls. There are two circumstances that can lead to such falls. One is a reduction in global demand, such as occurred during global recessions between 1980 to 83 and between 2007 to 2010. In these particular instances, the inelastic demand curve temporarily shifted back to the left, causing the market clearing price for oil to return to lower cost crudes. And in both instances, production was initially slow in responding to the drop in demand, leading to periods of excess supply that drove oil prices down even further. Eventually, prices stabilized as lowered production met new lower demand levels. And then, prices began to rise again as demand returned to rising. The other circumstance that can cause prices to drop is a technological advance that lowers the cost of once expensive to produce reserves of crude. This is what's happened over 2013 to 2015 as reductions in the price of horizontal drilling and fracking have enabled these technologies to be used to extract once costly shale oil. Extraction costs for shale oil have now dropped to $65 a barrel in 2015, adding some 9 million barrels per day of production at a supply level that formerly could only be met with $75 a barrel oil from the Canadian oil sands. As in the past, prices will once again rise if demand levels start to creep up towards 100 million barrels a day. What's uncertain is when that demand increase will occur and how much more shale oil reserves will be added to the supply curve before the increase happens.